the live stream today. Excited to kick it off with this amazing panel, of course. What we're going to talk about today is RWAs, of course, the current scenario on RWAs and what would it really take for some of the killer apps to be built on top of it. Before we go ahead, let's meet our guests. So I want to introduce this panel today to you, Liam from Chainlink, Global Head of Stablecoins and RWAs. Welcome. Thanks for joining, Liam.
Thanks, and thanks for the invite. Looking forward for a great chat here.
Awesome. And we obviously have Andrei, Managing Partner of DWF Labs.
Yeah, hey guys. Yeah.
Good and to be lastly, here. Artem, Chief RWA Officer at Falcon Finance. Welcome all.
Thank you. Glad to be here.
Awesome. Okay, super thrilled to have you, obviously, to talk about this topic. Tokenization is having its moment, like we all know. BlackRock has even compared tokenization with the internet in 1996, right? And every institution today has a tokenization desk already, or they will probably have one soon. So what we want to unpack with you today is which use cases will be built on top of this excitement that everyone has, and what will be the gold standard applications for those use cases that could look like as the space evolves. So let's start with this exciting number that everyone's talking about, because the on-chain RWA market just hit $30 billion in April. And that's like roughly 300% year over year. And there's a lot of forecasts, which is like going wild, 1000x by 2034, 2030. So what I wanted to really unpack is, maybe Andrei, we can start with you. What are you really seeing in the RWA market closely? And is this raise actually going to go 100x by 2034? Or what will it take to hit these numbers?
100x, I don't know, maybe, but the key point from our point of view and from my point of view that people want and market wants to have a seamless trading opportunities. And we see that trading volumes of tokenized commodities and tokenized stocks are skyrocketing, because it's very convenient for people, for example, to buy BTC, then sell BTC and buy gold. Sell gold, buy, Tesla, and do this on a seamless way, right? And on self-custodian way, if you want, right? On DEXs or SEXs, it doesn't matter. This is the first point, right? And the second point, and this market will be growing, and it is growing, right? The second market is tokenized real-world assets that are not widely traded. For example, tokenized treasury bills, or tokenized debt, or tokenized land, or some other not very liquid equities. This market is very big, but trading volume is very small. And I think we are still in kind of R&D market period, when the market and tokenization platforms and asset owners are thinking how to use these tokenized things. Yeah, this is the largest question that should be answered before we are moving forward.
Yeah, no, absolutely. I'm actually hearing this as well. This number is somewhat directionally exciting, but the quality of this 30 billion that we have achieved is not evenly distributed today. And like you said, it's still in like some specific buckets, and expanding it to other assets should definitely be the focus, and time will tell if that happens. But yeah, that's a great wrap up of the numbers. Artem, does that match with what you're seeing on the issuance side as well? How can the industry work towards distributing this evenly, in the pie across other assets?
Yeah, I would go even a bit deeper. So not just compare like different asset classes of real world assets, but there's a lot of things happening under the same roof of tokenization, because everybody using this word quite heavily, but what's actually happening depends on who's using this word. So tokenization can be used for like improving some internal process of the corporation, like using blockchain rails to actually bookkeep some assets or some numbers, and it's also called tokenization. That's why we have these crazy numbers like, okay, 50 bill tokenized, I don't know, 100 bill tokenized. In my point of view, it doesn't matter, to be honest, how big is the number. What matters most is what we can actually do with this asset. Andrei gave a great example of, I think, one and only asset class of tokenized assets that really found it product market fit, because it's really easy to deal with different types of volatile assets, and there is definitely a user for this kind of tokenized assets, because it's just easier to work like this. For most of other assets, like we see a lot of issuances with, I don't know, 5 holders of a tokenized asset, 1 holder of a tokenized asset. Does it make sense? Yes and no, because it's not that easy to build this market from the scratch, and tokenization is a part of finance ecosystem. Finance ecosystem is usually quite slow. Users and corporation need some time to understand the topic, to get used to the topic. So I think numbers are good. We can still push on ourselves. Okay, let's have trillion, I don't know, whatever, next year. But from my perspective, the most important question: what we actually can do with these assets? How can we use this asset? Can we build something on top of these assets? And with these questions, we're not quite there yet. We're still quite early. So I think it's going to change a lot for the next couple of years. Yeah.
Yeah, no, we'll definitely come to that as well, like how we can use this better in a minute. But just wanted to also touch upon with you, Liam, since you sit on the infrastructure side of things, right? And Chainlink is integrated with so many institutional pilots that are happening at this point. When you look at the rate of integrations versus the actual production volume, what are you seeing there?
Yeah, so we do a lot of pilots, but I think people fail to realize the scope of what Chainlink does in the market right now that is in production. If we talk about, for example, tokenized equities and the different issuers that are out there, done in different formats. So you have Securitize that is doing it in a way, you have Superstate, and then you've got Ondo, you've got Xstocks and Kraken. Chainlink today is already live and pricing all these equities that are live on chain, which is an essential component to unlock that utility that Artem and Andrei are talking about, which is lending and using these assets as collateral. So these are all productions. Actually, in fact, we've announced that Chainlink has passed $30 trillion of total value enabled since its inception. That's all in production, pricing, live, ready. And that's true for different asset classes as well. So we provide NAV data for tokenized funds, tokenized money market funds, tokenized private credits, but also for commodities like gold, silver, precious metals, and others. Coming back to your earlier point, and I agree with Artem here, the number it's interesting to know that there's $30 billion of tokenized assets on chain, but that's just really a small drop in the ocean of capital markets, basically. I would say that right now we are all in a very successful live proof of concept where we have proven that we can put assets on chain. We have proven that we can do some stuff on chain, but we have yet to do that at scale with institutional capital coming in, buying these assets, trading them, creating the necessary liquidity, the necessary liquidation facilities, and the utility needed for more capital in the hundreds of billions to actually flow into these assets. So I would say we're making a lot of progress, and indeed, the chart, if you look at the chart, is only going up. But there's still a long way to go.
Yeah, 100%. And just to double click on that, when I was talking about the internet analogy, right? If you look at the internet, browser was this huge unlock for the internet. And like you said, and everyone else said on the panel, that we're just like at the very early stage at this point. And, once we unlock utility, that's when we know where we're going. But still, numbers are really interesting. So what do you think, according to you, is going to be the unlock for tokenization, or has it already happened? or is it going to be like, cross-chain settlement, for example, or like more around the compliance side of things?
I think it's a lot of things. One thing I'm actually very excited about right now is actually US equities in general, which I used to not be very excited about because I've been in the tokenization space for 5 years now. Just personal background, I was previously at a company that was doing compliant tokenization since 2017 when there wasn't much going on in the space. And I remember in 2017, 18, the main use case that were brought up for tokenization were we're going to be able to tokenize very exotic products or private equity funds and stuff like that, and give access to retail investors. And it turns out that these projects were not so successful, even if you bring very high quality assets on chain, like Hamilton Lane private equity funds. And the way I look at it now is it makes sense because ultimately people will buy what they know. And that was true for stablecoins. That was the first sort of successful tokenized asset, successful use case at large, tokenized cash. And it's going to be true for every asset class. People are always going to buy what they know, what they're familiar with. And US equity is something that everyone already has exposure, or a lot of people have exposure in the real world. And blockchain gives the ability for even more people to have access to that right now, which might not have access in the real world. So you kind of solve two things. You give access to people that are familiar with this asset class and own it off-chain, but you also give access to people that do not have the ability to buy it off-chain. And then when it comes to compliance and liquidity, I think everything is needed still. Compliance is going to be a big need if we talk about institutional capital. Privacy maybe at some point will come. Not sure that every trading shop will want their position and their strategies to be fully visible in public. And liquidity and liquidations. That's my opinion.
Yeah. Also wanted to check with you, Andrei. You mentioned that you also mentioned that we're at a very early stage, and these numbers are exciting, but they're not like just they don't matter as much as of now. Which are the categories that you're seeing evolve? Like today, we have the biggest categories, probably tokenized treasuries, right? Do you see real estate and these a bit of these categories evolving in tokenization real soon?
Look, I think we should consider tokenization not like a way to unlock some locked liquidity, right? It's a way to make liquidity more transferable, more, if it's needed, transparent, and more convenient in terms of trading, right? We're talking about real estate. Real estate, historically, it's not the most liquid asset, right? And if we tokenize it, I don't think that liquidity will come because the nature of asset doesn't change, right? I think if we're talking about tokenization, right, and growth of this, and if we compare it to what, as you said, BlackRock said that tokenization is like internet in 1996, right? What internet improved? Internet improved a velocity of communication among people, right? People could faster find information and could faster communicate to each other, right? It's kind of access, velocity of access. Here, I would say it's kind of similar, right? Tokenization improves velocity of trading and of asset transfers, right? Things that can be traded faster, for example, stocks, commodities, I don't know, treasury bills, or any form of fiat currencies, it will be highly improved. Things that cannot be traded, right, on that way, let's say real estate, land, I don't know, some cars, watches, right? I don't think the trading volume will spike or liquidity will spike. No, it may be tokenized just to make these things aligned with the rest of the market, but they will remain the same. But trading volumes and liquidity of widely traded assets will be improved, of course. Yes, this is my opinion.
Yeah, no, absolutely. I think you said it really well. When the internet unlocked, the flow of information became so easy, right? Between you could just like flow information very easily across different entities, people, and that's exactly what needs to happen here with assets and trading, like you said. Want to bring you in, Artem, here as well from the product side, right? When an institutional allocator looks at these tokenized assets today, what do you think is the friction that they experience when it comes to like moving big sizes, specifically?
It's a really good question, I think, and it's pretty correlated to what Liam and Andrei just mentioned. So my view here is different types of assets have different types of buyers, right? And absolutely agree that if we'll tokenize money market fund, okay, maybe some retail user will buy this tokenized money market fund, but not that much. If we'll go further with the curve risk reward and tokenize, I don't know, some complex deal, or tokenize real estate, or tokenize something really difficult to understand, liquidity wouldn't appear magically there. Why liquidity can appear in these complicated products? Only when institutional buyers, those guys who trade these assets already, will come to the space. Why and what do we need to have on the space for them to come? We need a proper regulation. We need these products to be like pretty much widely understood. We need some sort of best practices in place. Like every CFO should be aware, okay, tokenized assets are not something crazy, Bitcoin connected, I don't know, North Korean hackers will hack my system. So it's like, it's a lot of education, a lot of adoption needs to happen. Of course, regulation, of course, privacy questions, of course, security questions. All these questions should be solved, should be in place for traditional buyers of the complex strategies and complex assets to come on chain and to start actually using these tokenized assets. So for most of allocators right now, if we're speaking about like complex strategies, it's like R&D. That's I also agree. They're trying to find out the way how to work with this. They're thinking, okay, let's tokenize like, I don't know, 50 million of some assets just to we'll see how it will go. So usually the process are quite long. Process requires a lot of discussion of the questions they never discussed before, like Oracle. If you start to explain what Chainlink is doing to some like classic CFO guy, it's gonna be you need to spend some time to educate the guy to what is blockchain, whose Chainlink is, why do we need that. So it's like it's a lot of education and a lot of friction still, plus the whole sort of vibe of the crypto industry with a lot of news about some incidents is not helping much to bring those institutional clients, because nobody wants to be like scammed or hacked. So yeah, it's quite a slow industry. So, and from my end, I think we're gonna be there, and it's not gonna be like internet, because internet is like a consumer product. Like, and internet provides consumers with a great access, and especially browser. Before browser, it was not that easy to communicate. With a browser, it became much easier to communicate with internet. Tokenized real world assets, especially complex ones, it's not like internet. It's a pretty boring and difficult to understand stuff. So it's gonna be a bit more complex process to bring the users, proper category of users on chain.
And if I can build on that, Artem, you're right. Of course, it takes a lot of education, but to be honest, obviously the crypto market is down. We've probably never seen as much traction or progress in the institutional world on our side. And yes, they're aware of the incidents that have happened recently, and of course, it's never good news for them. From what I've seen, it doesn't slow them down from their blockchain journeys. Like you said at the beginning, every bank, every asset manager or major asset manager, major bank have a Web3 desk right now. what I really am excited to see is that these desks are shifting from innovation desk to pure P&L owner and decision makers. So they're not thinking anymore of how can I do my first use case and be able to do marketing about it. They're thinking of actually how does it help our business? How can we generate profits on these products? Which tells you we are at a step that is a bit more mature in their journey. Which also means that things take longer because people are figuring out what is the right business model for them in this world.
Yeah, totally. So now moving on to some utility aspects that you rightly called out, right? And I think when we talk about utility, the first one comes to mind is using collateral in crypto trading or derivatives venues, and that's kind of like live now in some products. But the thing is, for a while, tokenization was mostly framed around just access and distribution. Let's just tokenize things, right? But when institutions look at it, they, like you said, Liam, they don't want just like things tokenized. They want assets that can actually move and they can generate profits, and it's like a business activity for them, right? And it should actually move through system, pledged, financed, reused, right? And this feels one of the biggest shifts also on the utility side in the market right now that we need to look at, and some players are looking at it and addressing it as well. So obviously, Falcon Finance comes to mind, Artem, and you're close to that product. Falcon Finance was built around the idea that assets should do more than just sitting and being tokenized, right? So when you think about collateral that actually works, what does that really mean in practice today for our users?
So Falcon Finance was built with an idea that every asset that we can bring on chain should be able to work on chain, not just sit on chain somewhere, but to be actually usable collateral. So we are using this universal collateralization engine slogan, and basically we are trying to work with every type of collateral that you can bring on chain. Every type of collateral requires different approach, of course, because if you're issuing a synthetic dollar, which is backed by different types of collateral, you need to be very careful on how to price the asset properly, how to be able to exit the position quickly, how can you reuse this collateral. And for example, if you're reusing the collateral and you're like doing some looping strategies, how easy would it be for you to unwind the strategy? How long would it take? Because it requires actual selling of the asset in the real world, and it's not T+0 usually. So it's quite a complex product. But yeah, you're quite right that we have a lot of opportunities right now. We have a lot of experiments right now, I would say. Not that much like on a scale. I think the most obvious example will be lending markets, and we've seen a lot of attempts to build lending markets on top of real-world assets. I wouldn't say that right now they're quite successful, but I think it's going to be one of the major use cases for institutionals, for users dealing with lending markets and looping strategies, which basically would allow them to improve the yield from the asset and to actually use this asset properly.
Yeah, and since it's a big utility aspect that can be added, Andrei, would want to learn from you on the DWF Lab side of things from the market viewpoint, right? Because you work with founders so closely, you talk to them. Are you seeing builders and founders reaching out to you or talking to you about the real demand and building collateralized RWA strategies as apps? And are builders actually focusing on this today?
There are many discussions how to build some strategies, DeFi strategies around tokenized reward assets, right? But frankly, we should also always keep in mind that no any yield is risk-free, right? And when we have, for example, treasury bills, right, and then the looping strategies on treasury bills, it kind of very, very low risk, right? But for example, if we use like many tokenized assets like private debt or whatever, not widely traded, right, it creates risks, right? And so it's completely okay, it's completely fine. But I think this point will be a quite big, deal breaker, because you go to let's imagine who is the client of it, right? We are not talking about retail, we are not talking about like small funds. Let's say that it's a large fund, right? So for the large fund to approach this crypto strategy, right, on, let's say even with looping, there are many risks. First of all, this is the industry risk. Crypto industry, it is a big risk, right, for many of people. Then regulatory risk. Then it is liquidity risk, right? And then it is kind of a risk of exotic strategy. Looping is an exotic strategy. It's not like a very common strategy, like basis trading, for example, right? And then we have something like which has risk inside another risk, which generates, let's say, 10%, 12% per annum, right? I'm not sure that it is enough to cover these kind of scares of such clients. I think that's the first thing that we should focus on, and the thing that the market will focus on is to use like very proper tokenized assets like gold, like treasury bills, like silver, something which is super liquid as a margin for trading. For example, if you do basis trading and you short BTC and long BTC spot to farm 10% basis, then you can use, for example, treasury bills as a collateral to farm another 3%. It is great strategy. And this is very simple and attractive. And then when people get used to use crypto, knew more, solve all the compliance questions, they will move a bit further in the space. But starting with something very, very crypto native, DeFi native, I think it's very hard, and we could see that it doesn't really work because it is big R&D. It should start from crypto native companies.
Yeah, I think that's a good point for builders to note down. All right, moving on. I think we've spoken about the TradFi, DeFi converging, and that is like one of the biggest reasons we're even talking about tokenization today, because institutions are a big play right now. And something really interesting is happening from both sides, right? TradFi and DeFi. So while DeFi protocols are building permission layers to absorb the capital, institutional capital, whether it's like whitelisted walls or KYC pools. And this shift is really interesting because this solves the core issue of compliance risk and the counterparty risk that previously kept institutions at bay, right? On the other hand, institutions are quietly building on-chain structures to access DeFi yields. So that's how they're like moving towards each other, DeFi and TradFi. What I want to really understand from you guys is this convergence helpful? Is this real integration? And do you think from a user or a UI UX point of view, shouldn't we be looking at things where a user doesn't really know whether they're using a bank or a smart contract, right? So how do you think this convergence happening and how will it evolve? Liam, maybe you can touch upon this since it could be interesting for you, yeah.
Yeah, I think one area that I'm particularly excited about right now is fintechs, because fintechs really sit in the middle of the banking world and the more modern users of banking products. And I believe that slowly, that's what you described as exactly what's going to happen, which is blockchain is going to be the sort of backbone rails. I think blockchain in itself, with its existing UI and UX that can be of course improve, but in its current state will continue to grow, because you'll always have people that are going to be willing to trade on chain, fully in a self-custodial way. And I think you'll always have a market that will exist and grow in the fully on-chain economy. However, I believe that more and more fintech applications are going to integrate blockchain rails to enable use case on their existing platform with their existing user base. An existing use case or example that I can give here is, there has been a lot of announcements from various brokers, neo-brokers about tokenized equities. One example that comes to mind is Robinhood. I could imagine that one very interesting use case for them is actually enabling lending in-app. So you have your Apple in your Robinhood app, and you could borrow directly in your app, which is something that retail, non-sophisticated users are not necessarily super familiar and don't really know how to do. You can do these things right now with your interactive broker's account. You can do these things, but not everyone knows how to do it. And I suspect that blockchain will open up more of these use cases where blockchain will be used as a backbone, invisible rail. What's going to be interesting as well is that blockchain will create these 24/7 markets because it relies on smart contract automation, peer-to-peer trading, and so on and so forth. And so you'll end up with, to Andrei's point earlier, probably more velocity, more trading, 24/7 infrastructure. And then when we reach that point where there's enough liquidity on chain, you'll be able to enable very interesting use cases in the Web2 interfaces that fintechs are providing to their users.
Yeah, and that shift is, like you said, quietly happening. And I feel, if blockchain rails are like hard-coded in these ecosystems, and on the front end, you don't really know what's happening, but it's just like you can access yields and you can access DeFi. That's going to be like really amazing, and that's what probably will get us more adoption. But yeah, I think it's an exciting time. All right, I think we also talked about a lot of technical issues that Artem, you touched upon, and one of the things that stands out here is, while I was researching, is looking at this problem of fragmentation within blockchains, which has been called out as one of the bottlenecks in the RWA adoption that that we'll have to look at some point, right? Just for our listeners, fragmentation is basically a digital equivalent of every bank in the world creating its own currency, but they are not able to talk to each other, right? So that in the blockchain world. And because of fragmentation, what's happening is that pricing gaps, there's some friction on the user side as well. So the question is that how are we going to address it? And there could be some consolidation happening because of this, like only a few L1s, everything consolidating there. How do you see we addressing this issue of fragmentation, and especially in the context of RWAs and tokenization?
Yes, I would describe this in a slightly different sort of angle. So usually in crypto, we're speaking about fragmentation, where what we usually mean is like we have a different chains and we have a liquidity fragmentation across the chains. What's happening in the real world assets? There is not like chains fragmentation; it's a legal system fragmentation, because you have different assets which is issued according to the different rules in the different jurisdictions with different technology inside, with different providers of data inside, and this creates even more complexity and more fragmentation. They cannot talk to each other because, for example, if you will use like some corporation or even the example Liam that mentioned, Robinhood stocks. So you cannot deal with Robinhood stocks on other like apps chains. They have like different steps, as far as I remember, on decentralization of the whole concept of Robinhood stocks. But at least when they started, he was able to trade tokenized stocks only inside one app. And I think it's a good example because we have a lot of different real-world assets that technically on-chain, but they are super fragmented because they're issued according to the different rules with the different data providers, with the different requirements for investors. So when we started the real world asset journey at Falcon, so I was onboarding Falcon to most of the issues of the real world assets. And you cannot imagine how different the process of onboarding are. So you need to spend like a few months just to onboard yourself as a market player to different kinds of issuers of real world assets. And for some of the issuers, opening an account with them, it's harder than opening a bank account. So it's like a lot of fragmentation. How to resolve it? I think only mass adoption plus regulation plus some best practices that will definitely appear, that will definitely be in place. We're not there yet, and I think like Chainlink is doing a great job trying to bring some best practices into the market, like at least in the data sphere, so everybody's like in Chainlink, it's like common sense, but still, we don't have only technical fragmentation here. We have a legal, compliance, and operational fragmentation. And yeah, it's kind of tricky, but we don't have any like silver bullet to solve this problem easily and quickly. But I think we'll be there sometime.
Yeah, you talked about mass adoption. That's interesting because most of the users today in crypto kind of sit with specific L1s, and they are also I feel consolidating at some at some point. So Andrei, I want to check with you from a business lens, right? Most of the volume consolidating in a few L1s, while it does ease a lot of friction from a user point of view. Do you think it's healthy for the industry, or do you think it's actually getting better?
First of all, everything in the world has consolidation, right? Liquidity is consolidated around certain currencies, right, and certain markets. It's like normal situation for the world, right? And basically, this competition among chains, the winner takes everything, right? And we see that if has the most of tokenized things, right, then Solana can be, and the rest is kind of very, very small, right? In terms of user experience, I think most of these frictions are managed on the application level and also on, for example, Chainlink level, right? There is no issues to shift assets from one chain to another because bridges are very advanced nowadays, and it doesn't take like years how it was like I don't know, in 2020, right? I think the situation in the market is very healthy, and nothing should be changed. The market organically decides how to work and which chain to use for tokenized RWA.
And I think, Andrei, you raised a really good point, actually, which is quite timely. The way we see fragmentation right now is, and to your point about different L1s and consolidation, yes, there is some consolidation, but we also believe that there's going to be more chains, potentially sovereign chains at some point, potentially still private chains, potentially banks having their own chains. And the idea right now is that we don't really know how this landscape will evolve, but we do know that even if there is consolidation, there's always going to be multiple environments where people trade, where there's communities of users that will use these networks and where liquidity will build up, and that will probably grow over time. Our view was always the same, which is security. Well, first of all, you need to solve for fragmentation, right? So if we are going to operate in a multi-chain environment, then you need to solve for the liquidity fragmentation, which is why we have created our own bridging / interoperability solution, CCIP, which Falcon Finance is a user. And I think if we talk about collateralization and lending, then obviously Falcon Finance is a major success story here. I think at the peak over $2 billion in TVL, and we've worked with Falcon Finance since the early days. So that's been a great successful story. So liquidity fragmentation, however, and that's to your point, Andrei, bridging has always been a critical, very critical area in the blockchain space. We've seen that recently with the Layer 0 hack. And the view we have at Chainlink is that security should always come first when it comes to our data products, when it comes to our compliance products, even when it comes to our cross-chain products. So yes, that's the 2 points we're trying to solve for in this fragmented environment, is reducing liquidity fragmentation in a secure environment.
Nice. All right, so we actually want to wrap it up now, but there's something interesting we have towards the end. Is we want to hear, since all three of you are working in the subject matter expertise in your area, and you're looking at solving a lot of these things. We want to hear like one milestone that you would see being solved, or a problem being solved, or a milestone being looked at, if we were to talk about this in 24 months from now, 2 years from now. So yeah, just to wrap this up, Andrei, why don't you tell us what would you like solved in 2 years in tokenization space?
I think in 2 years, right? Volume should be bigger, right? More commodities to be tokenized, more stocks to be tokenized, listed, right? And more exotic money market funds or liquid funds to be tokenized and listed, right? For example, now you can trade bonds somewhere, but you will be able to trade bonds on crypto. That's what I'm thinking. And it's definitely regulatory framework will be more aligned globally.
Interesting. Yeah, that's a really good one. Liam, what do you would want to see solved in 2 years from now?
Yeah, regulation, obviously important to give clarity to any issuer that's trying to issue an asset and trying to figure out how to not, end up in a bad spot from a legal perspective. So regulation is important. One thing I do see right now a lot is how people think about liquidations of non-liquid assets, such as private credit assets. So infrastructure around liquidations for non-liquid RWAs is something that I would like to be solved in the next year or two.
Yeah. And Artem, I think you already mentioned a lot of things, but anything that's close to your heart?
I think the number I would watch would be not how many assets was issued, but sort of active usage. So what percentage of tokenized asset is used as collateral? Settlement liquidity, margin repo, structured product backing in lending markets. And I think success would be when we have like 30% of all distributed real-world assets actively used inside the financial system, financial strategies, not 10% or 5% like we have right now, like 30 plus. And the second major thing is also corresponding to what Liam and Andrei mentioned, when like corporate treasury guy would consider tokenized asset similar as the regular asset. That would mean that we have a regulation, that we have the proper standards in place, that we have sort of best practices in place. If TradeFi CFO guy will consider both versions of either tokenized or non-tokenized as a same asset.
Awesome. Yeah, those are some of the big ones, I guess. We're going to clip this segment for sure. All right, so we're at time, and Andrei, Artem, and Liam, genuinely one of the great conversations on RWA I've had on this topic, and I think the audience and listeners are going to feel the same. So thanks a lot for joining, and to everyone watching, thank you for showing up. We'll see you in the next one.
Thank you.
Thank you.
Thank you.